All right, so you've been looking into getting into trading, huh? You've been sent over some resources you've been checking out. Pretty cool stuff. So for this deep dive, we're going to cut right to the chase. You know what I mean? We're talking about the things that really, truly matter when you're just starting out building that solid foundation and sidestepping all those classic beginner mistakes that can really trip you up.
Yeah, absolutely. From the stuff you sent over, two things really jumped out at me as being super important for anyone who's just taking those first steps in trading, putting together a rock solid trading plan, and then really getting a handle on smart risk management. Forget all the hype and promises you see out there. We're all about giving you practical, actionable stuff that you can actually use. No fluff.
And to really drive home why these aren't just like optional extras, but absolute must-haves, let me tell you a quick story about someone we'll call Anna. Okay. She started with $1,000, decided to give trading a shot. And get this, within a week, her account had doubled. 2,000 bucks. Sounds pretty amazing, doesn't it?
Yeah, it does. I mean, that first taste of success can be really exciting, even kind of intoxicating. It can lead to a false sense of security, though. Like, oh, I've got this figured out, but
Yeah. But here's the thing. Just as quickly as she made those gains, poof, gone. Every penny. No plan, no safety net. And that's exactly the kind of scenario we want to help you avoid in this
yeah.
deep dive. That's what we're here for.
So let's jump into that first crucial element, your trading plan. Think of it like your roadmap for navigating the markets. It's what helps you steer clear of those impulsive emotional decisions that can really derail a lot of beginners.
Okay, let's break this down. Your sources had some great questions that everyone needs to think about when they're creating their own trading plan, right? Let's go through them one by one. First things first. How much time realistically can you dedicate to trading every week?
Right, and that might seem like a pretty basic question, but it's honestly the foundation. Are we talking full-time? Part-time? Maybe just squeezing in a few hours here and there? Because being honest with yourself about how much time you can actually commit, that's going to shape everything else. It'll influence what kind of trading strategies make sense for you, what financial instruments you choose to trade,
Yeah.
all that.
Makes sense. I mean, someone who can only spend a couple hours on the markets each week is going to need a completely different approach than someone who's glued to the charts all day, every day. Okay, so time commitment, check. Second big question is, what specific financial instruments will you actually focus on trading? Your sources mention things like Forex, indices, commodities, that kind of thing.
And this is where the idea of starting small is super important. It's tempting to want to trade everything, right? But honestly, that can be overwhelming. You end up not really mastering anything. Forex is the global currency market you're trading, euros, dollars, yen, all that. Indices, those are like snapshots of how a group of stocks are doing, like the S&P 500. And then you've got commodities, oil, gold, raw materials.
Yeah.
So by picking one or two of these to start with, you can really dig deep, learn the ins and outs.
Yeah, it's like trying to learn, I don't know, 5 different languages all at once. It's probably better to focus on one or two, right? Get a good grasp on those first. All right, third essential question for your trading plan. What exactly will be your entry and exit strategies? This sounds a bit more technical, I guess.
Oh, yeah, but it's super important. This is where you decide in advance what specific conditions will trigger you to open a trade. And just as importantly, what conditions will tell you it's time to close that trade, whether you're taking a profit or cutting your losses. And these rules need to be based on your analysis, not on your emotions, right?
So no more gut feelings, huh? No more, I have a good feeling about this trade kind of thing.
Right. It's about taking the emotional roller coaster out of the equation, your trading plan. That's your framework for making disciplined decisions. It helps you stick to your strategy even when things get crazy volatile. All right, the fourth crucial piece of your plan, and we'll definitely get into this more a little later, is how much are you willing to risk on any single trade? This is about setting limits to protect yourself.
Okay, risk per trade, got it. And the fifth and final piece of the puzzle, according to your sources, is how are you going to track your trades and see how you're doing? And they talked about using a trading journal, right?
Yeah, a trading journal, that's a game changer. It's basically a detailed record of every single trade you make. Why you entered the trade, why you exited, what the outcome was, any lessons you learned. By looking back at your journal, you start to see patterns, what's working, what's not, where you can improve.
It's like having a personal trading coach, but it's you from the past, basically.
Exactly. All those experiences, all that data, it's incredibly valuable.
So it really feels like this whole trading plan thing is about bringing structure and intention to a world that can feel pretty chaotic, wouldn't you say? I mean, it's kind of like a musician practicing scales. It might not be the most exciting part, but it's absolutely necessary if you want to get good.
Perfect analogy. Just like any other field where people want to be successful, right? Successful traders, they approach the markets with a plan. They don't just wing it. Okay, now let's switch gears and talk about that second vital element, risk management. This is the big one. This is what separates the traders who last from the ones who, well, don't.
Okay, so if the trading plan is like our roadmap, then risk management is like making sure we've got enough gas in the tank and we're not driving off a cliff. It's about protecting what we've got.
Yeah, exactly. And the number one rule, the thing you absolutely have to remember, is this. Never risk more than 2% of your entire trading account on any single trade. 2%. That's it. It might seem small, but trust me, this is the key to staying alive in the market over the long haul.
So let's say someone's starting with a $500 account, right? Just to make this super clear, how much, Max, should they be risking on a single trade if they're following this 2% rule?
So 2% of 500 bucks, that's $10. That means even if you hit a rough patch and have a bunch of losing trades in a row, your overall capital is still pretty safe. Let's say you have 5 losing trades back to back. That's 50 bucks total, which is 10% of your starting 500. Not great, but it's manageable. You still have the vast majority of your money to keep trading.
Wow. Okay, that really puts it into perspective. It's not about hitting a home run every time, right? It's about playing the long game. Now, your sources also mentioned something called stop-loss orders. What are those, and how do they help us manage risk?
Okay, so a stop-loss order is basically an instruction you give to your broker. You're telling them, hey, if the price of this thing I'm trading moves against me by this much, automatically close my trade. It's like a safety net that limits how much you can lose on any given trade. Really important stuff. But, it's not a foolproof guarantee. Like in a really fast-moving market, there's a chance the price might slip a little bit past your stop-loss level before the trade actually gets closed.
So it's a must-have, but it's not a magic bullet that's going to work perfectly in every situation.
Yeah, that's a good way to put it. It drastically reduces the chances of getting wiped out, but it's not perfect. Okay, now let's talk about leverage. Leverage is often sold as this way to, make a ton of money really fast with a small account, but as your sources said, it's a double-edged sword.
We've all heard those stories, right? People using leverage to turn $100 into 1,000 overnight. What's the catch? What do beginners really need to understand about leverage?
The key thing to remember is that leverage, it amplifies everything. It magnifies your potential profits, but it also magnifies your potential losses, both sides. If a trade goes in your favor, awesome, your gains are bigger. But if it goes against you, your losses are also bigger, and they can add up really fast, way faster than people realize.
Makes sense. So chasing those huge leverage gains, that's often a recipe for blowing up your account, especially if you're new to trading. And this brings us to a question I know a lot of people have, and your sources actually addressed it head on. Can you realistically turn $100 into $1,000 in a week through trading? It's like the dream, right? Make a bunch of money super fast.
Yeah, it is. And you hear those stories, and it's tempting to think, well, maybe I can do that too. And technically, if the market's moving like crazy and you get super lucky with a bunch of perfectly timed, highly leveraged trades, is it mathematically possible? Maybe, in some very specific scenarios, but is it realistic? Is it sustainable? Is it a smart way to approach trading, especially as a beginner? Not really, no.
So what's wrong with that whole get-rich-quick mentality when it comes to trading? Why is it usually a bad idea?
Because trying to make that much money that fast, it almost always means taking on way too much risk. You'd probably need to use a crazy amount of leverage, which means even a small move against you can wipe you out. It stops being about strategy and becomes pure gambling.
Okay, so it's basically a high-risk gamble with a very low chance of actually working out in the long run. And it sounds like a much better approach is to focus on building something more, sustainable is the word.
Yeah, exactly. The best traders, the ones who are in it for the long haul, they prioritize protecting their money above everything else. Their thinking is, if you can keep your capital safe and stay in the game, you have more chances to learn, to figure things out, and to eventually become profitable consistently. It's about slow and steady growth, much more reliable than trying to hit a jackpot and then losing it all.
All right, this has been an awesome deep dive into the essentials of starting to trade. So much good stuff here.
Yeah.
So for our listener, what's the next step? What should they do now based on what we talked about today? What's their homework?
Homework time, yeah. The most important thing is to sit down and actually write out your own personal trading plan. Go back to those 5 key questions we went through. How much time can you commit? What are you going to trade? What are your entry and exit rules? What's your maximum risk per trade? And how are you going to track everything? Use a trading journal for that, like we talked about.
Seriously, don't skip this step. It's crucial. By having a plan and actually sticking to it, and by being smart about risk management, you're already way ahead of the game. Trust me.
It's about being intentional, disciplined, and thinking long-term, right from the start. No shortcuts.
All right, so that wraps up this deep dive. We hope this was helpful and gave you a solid understanding of how to get started on the right foot.
Trade smart, stay disciplined, and protect your capital. Those are the big takeaways.
And one last thing to think about. Beyond just wanting to make money quickly, what's your own personal tolerance for risk? How much are you comfortable potentially losing? And how does that fit into your overall financial goals? Think about that, and maybe even do some research on different risk-reward ratios in trading. It's worth taking the time to really understand that stuff.